Hi guys, good evening. Uh, Welcome back. Again, Friday we did not have a class because a lot of the college students are having college exams. But this is what we had looked at on Wednesday. So on Wednesday, we completed the corporate governance chapter, and I had moved on to the fifth chapter, which is risk. Now, again, please realize that things are getting a little serious now. What do I mean by things are getting a little serious? Is remember, there are 15 chapters in your textbook, and we're in the fifth chapter now. Meaning, what? Today is 7th of April. First of all, please do appreciate that we started the classes much later. By the time this batch started, it was already 21st or 22nd. We started late because by the time we had the demos, everybody joined, it was a little bit of a delay. Normally, we start batches by 10th, but we started your batch entirely almost 12 or 13 days late. But still, we are on track. We're now in the fifth out of 15 chapters, right? Technically, meaning that we're completing 1/3 of the syllabus. And things are not necessarily going to get hard. I mean, the difficulty level is going to stay the same. Difficulty is not going to increase because don't worry, we have things sorted for you. I have handled at least 25 to 30 batches of AA over so many years. So don't worry, difficulty level will stay the same. It's which month? February, March, April. We're in April, right? So 4. So the 7th of April, we're starting off with what? We're starting off with risk. All right. So again, the first few minutes is basically where we do a quick recap on the previous topic. And this is what we had looked at. Right, we looked at audit committee. There was a little this chapter in general corporate governance. People find it a little boring because it's just too much. There's not much of practicality. It's just knowing what each committee is. That's all. But now we are looking at risk, and risk is a very interesting chapter. So, how many people do I have online? I have Manan, I have Vineet, I have Asmeet, I have Arjun, I have Anil. Ritika is not there, but most of my regulars are here. So let's get started with what is risk. Risk, in simple words, is simply danger. In simple layman terms, risk means danger. What do we mean by risk means danger? See, it's like this, that in the financial statements, there is also always a risk, always a danger that there could be mistakes. It could be either because of a mistake, an error, or fraud. It could be because of both. It could be because of error, it could be because of fraud. Now, even before the auditor looks at the financial statements, there is a risk in the financial statements that the financial statements have a mistake. What do I mean by that? Let me give you a simple analogy to understand. Right? It's like before you These are the financial statements. And you are the auditor. You are yet to audit these financial statements. You are yet to examine these financial statements. These are your financial statements, and audit is what? Examining. Even before you do audit, even before you do examination of the financial statements, there is a chance that there will be misstatements. One misstatement here, one misstatement here. Now, again, that misstatement could be because of error or could be because of fraud. But even before you do anything, prior to the audit, there could be a risk of a misstatement. That risk, that danger of a misstatement in the financial statement is risk of material misstatement. So if I show you the textbook, the risk of material misstatement is that risk that stays in the financial statements, that risk that the financial statements are materially misstated, even before I go and check, is risk of material misstatement. I'll give you one more analogy. See, I am going to correct your notes. Okay. But even before I come and check your notes, there is a danger. What is the danger? The danger is that there are mistakes in your notes. There's a mistake here. There's a mistake here. This misstatement, this risk, this danger that even before I check your notes, there are mistakes there, that risk is risk of material misstatement. Now, ignore the word material because I will explain that in a lot of detail later. But risk of material misstatement is even prior to the auditor coming and checking the financial statements. Before that itself, there is a danger, there is a risk that there are misstatements in the financial statements, either due to error or fraud. I don't care, but there is a mistake. So what is a risk of material misstatement? This is the risk. This is the risk that there are material misstatements in the financial statements before the auditor comes and checks. So even before I come and check your notes, there is a chance. I know for sure there is a chance, there is a danger that there's a mistake in the notes. So what is risk of material misstatement? I hope that is clear. Risk of material misstatement, done. End of story. Now, what is the next thing that we will look at? What is the next thing that we have to look? The next thing that we have to look at is what is a misstatement? Right? Guys, forget. Just completely forget. Double A. Completely forget it. I want to tell you something. And what I want to tell you is this. What do I want to tell you? So, what do I want to tell you? We are in the year 2013. Believe me, we are in 2013. We're in 2030. Is it okay, guys? Are we in 2030? Are we in the year 2030? No, definitely not. We're in 2025. So a misstatement is wrongly making a statement, as simple as that. Wrong. Misstate means it's a statement that is wrongly stated. Something that is wrongly stated is a misstatement. So a misstatement is when something is wrong or off in the financial statements. Right? Maybe there is a mistake in the number. There is a wrong number. For example, if I tell you, now again, this isn't related to financial statements, but this is definitely related to, just for your example, right? I have, again, Arya Priya Bhuyan. Again, Arya Priya, I don't see you in the no, RLMS. Let me just have that checked. But Anil, Arjun, Ashmeet, Vineet, Manan, I have about 5 people, right? So if I tell you that there are 8 people in this, or if I say there are 10 people in the class, this is a misstatement, right? So it could be a number that is wrong. It could be something that is in the wrong place. It could be something that is described the wrong way. It could be anything that is wrongly stated. So what is a misstatement? A misstatement is, again, in simple words, anything that is wrongly mentioned, wrongly stated. Right? A difference between the reported amount, classification, presentation, disclosure, blah, 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 and the amount that is required for it to be correct. Basically, I tell you that there are 10 people in the class, but there are only 5 people in the class. This is a misstatement. This 10 is a misstatement. I hope that is clear, guys. So just make a note on what misstatement is. Again, you keep life simple for you, put things in simple words, and AA will be very easy. Again, Vineet, I've given you time to just make a note of that. I hope there is no problem with what is a misstatement. Now, again, we're looking at the various categories or types of misstatements, right? Now, again, say this, I'm just giving you an example, okay? The sun sets in the, where does the sun set? The sun rises in the east and sets in the west now. So the sun sets in the east. So again, Ashmeet, nobody is really going to ask you definitions, but definitions, remember, by definition, definition is something that is what it is. Definitions don't really change. Here, I don't believe in giving you definitions because you can always read it. You don't need a class for it. What I have done is I have explained to you what a misstatement is. So when you go and do audits, you need to know what is a mistake, something that is wrongly stated. Simple. The sun, or forget the sun, okay? It is the year 2030. When I say that we are in the year 2030, Belinda has also joined. This is a misstatement, and this is a misstatement about which there is no doubt. There is no doubt about this misstatement. It is by fact misstated. That type of a misstatement about which there is no doubt and there are facts to support it is a factual misstatement. There is no doubt about this, right? If somebody tells you India is in the West, this is a misstatement. This is a misstatement, right? Because India is not in the West. This is a misstatement about which there is no doubt at all. It is a fact that India is not in the West. Therefore, this misstatement is known as a factual misstatement. I hope we're clear on that. Right? So, what is a factual misstatement? A factual misstatement is a misstatement about which there is no doubt at all. Something which is wrongly stated as a matter of fact. If I tell you Manish is a girl, right? Now we all know Manish is a man's name. So it's a factual misstatement. Manish, as a matter of fact, is a boy. So these type of misstatements about which there is no doubt at all and is supported by facts is a factual misstatement. Next is judgmental misstatement. What do I mean by judgmental misstatement? I'll give you an example, okay? Mm-mm. Okay, just give me 1 second. Okay. Now, tell me one thing. Each of you, this guy, based on the proportion of the drawing, tell me how tall is he? Everybody put an answer. How tall is this guy? Based on what? Just make a guess. Beneath says 5'8". Again, Babu, we need to close that door. Made the door is open. Manan says 5'10". Beneath says 5'8". So based on your judgment, you are making a statement, correct? But from what I am able to see, I'm the auditor. And from what I am able to see, I feel, because I'm able to see that his hands are very long. So from what I am able to see, I feel that this guy is 6 feet. Now I will say you what you are saying what Manan has told, what Beneath has told is misstated. Beneath says 5'8", Manan says 5'10". But I'm saying Beneath says 5'8", Manan says 5'10". I'm not sure if I'm pronouncing your names correctly. Right? But according to me, that guy is not 5'8" or 5'10". According to me, that guy is 5'11". So I feel that Beneath and Manan are wrong and they are misstated. But this is not a misstatement as a matter of fact. I mean, I did not go with a measuring tape and I did not check his height. As per my judgment, Beneath and Manan are wrong. I feel he's taller. This will happen in your day-to-day life many times. You feel that you will reach the party by 7 o'clock, but your friend says, no, now there will be traffic. We will reach at 7:10. So according to your friend, you are misstated. According to his judgment, you are misstated. And that kind of misstatement is known as a judgmental misstatement. Right? Many times the company will use estimates. The company will just make a guess. Again, guess is not the best word, but the company will make an estimate. But the auditor, according to his judgment, he feels that the company is wrong. Just like how, according to my judgment, I feel Beneath and Manan are wrong. I'm giving this example because this is something similar which happened just yesterday personally. Somebody was guessing somebody's height, and one person says 5'6", but I thought that guy is much taller. Right? So those type of misstatements are known as judgmental misstatements. What is a judgmental misstatement? A judgmental misstatement is where the auditor, according to his judgment, feels that the company and the management is not right. The financial statements are not correct. They are misstated. For example, in the financial statements, we say that this machine will last for 10 years. But the auditor looks at the machine and says, what? How will this last for 10 years? I think it will get spoiled in the next 4 years. So according to the auditor, the company is misstated because of the judgment. And that kind of misstatement is known as judgmental misstatement. I hope everybody is clear and comfortable with that. Then comes projected misstatements. What do I mean by projected misstatements? Oof. Let me give you an example. How many times has it happened? Forget double A. Okay? In your life, has it ever happened that the teacher asks one question to a student, to student one, to student one. Student one does not answer. Student two, he then asks, okay, you answer. Student two stands up and student two also does not answer. Then she looks at the third person. She says, you stand up. Student three. Student three does not answer also. Okay. Then she looks at the fourth student and says, student four. Student four also does not answer. Now, what does the teacher after that? What does the teacher do after that? She will start scolding everybody, correct? And she will say, nobody has studied, even though there are about 40 other students. Because the first 4 students did not answer, the teacher will be very angry. She will say, nobody has studied. Why? Because the teacher's sample or the few students the teacher asked, nobody answered. So the teacher is projecting. Projecting means what? Forecasting beforehand itself. For the other 40 students, the teacher is saying they also have not studied. It's a projection. You understand? We've taken a sample, and from the sample, we project and say how many misstatements are there in the entire numbers. For example, I take a sample of invoices, and 20% of the invoices which I checked were misstated. So what will I say? Remember, I only checked a sample of invoices. I did not check all the invoices. Only few invoices I checked, and that 20% were misstated.
It's 6 o'clock.
What will I declare? I will say, I will project based on the sample that I have taken. I will project and say 20% of all the invoices are misstated. That kind of misstatement is a projected misstatement. Now, a projected misstatement is the auditor's best estimate of the total misstatement after checking a sample. Are the estimated misstatements according to the auditor after having checked a sample. So guys, I hope what is misstatement along with the types of misstatement is clear. Misstatement is simply something that is wrongly stated either due to fraud or error. I don't know. What is a misstatement? A misstatement is something that is wrongly stated either due to fraud or error. I don't care. Misstatement, anything wrongly stated either due to fraud or error. There are 3 types of misstatements that you need to be aware of: factual, judgmental, and projected. Let's see if there's any problem in this. Any issues, guys? All clear? Perfect. So we've looked at risk of material misstatement. We've looked at what is misstatement. We've looked at types of misstatements. Factual, judgmental, and projected. Right? Now we move on to look at risks. Inherent risk. We look at, say, control risk. Look at detection risk. First, let me explain what is inherent risk. So, what is an inherent risk? See, in simple English, in simple, basic English, inherent means natural. Inherent means what? Inherent in simple English is natural. For example, making, say, what? Okay, I'll come to an example later, but inherent means natural. So inherent risk is the natural danger that something could go wrong. Natural risk that something could be misstated. For example, you are making a cheesecake. Now, it's not easy to make a cheesecake. There is a risk that the cheesecake won't turn out well, because making a cheesecake is not easy. And anybody who's making a cheesecake, you will, if you ask them, they will say, "Oh, yes, there is a risk that it might not turn out well. We cannot make it properly. Maybe something will get spoiled." There is a natural danger that the cheesecake doesn't turn out well. There is a natural risk. That risk is known as inherent risk.
Sir, take one more example about the company.
Yeah, I'm giving you. Natural risk that something will go wrong. Right? For example, you have some complex accounting work that needs to be done. Now, the fact that the work itself is complex, the fact that the work itself is difficult, there is a natural risk that you will make a mistake because it is complex. Those risks are inherent risk. The natural danger that something will go wrong. Another example is where we are discussing something which is very subjective. Right? I mean, happiness in life, I don't mean to be philosophical, but just for the sake of explanation, happiness in life is something very subjective. Some people feel happiness in life is having a good time for yourself, good time to do whatever you want, having peace of mind. Other people will say happiness in life is having money, having cars, and both are not wrong. I mean, it's a subjective matter. So same way, when it comes to a company, estimating useful life is subjective. I might say, okay, I can use this laptop for another 1 year, but you might say, okay, you can use it for 4 years. It's subjective. So there is a natural risk that because it is subjective, one person will feel 1 year is the useful life, another person will feel 3 years is the useful life. So the natural danger that something will go wrong is an inherent risk. Right? What is inherent risk? Inherent risk is the natural risk that something could go wrong. Forget controls. Naturally, the susceptibility means the danger that something is wrong before any related controls are applied. So naturally, automatically, there's a chance that we'll make a mistake. That risk is inherent risk. I hope that's clear.
So what
So-
question come in the exam in this topic?
Sorry?
What type of question come in exam in this topic?
See, we have this class in this session, we're talking about doing the syllabus, the textbook. Right? When it comes to the exam as such, obviously, we have separate sessions where we are recording content and helping you answer exam style questions. So it will come there. Okay, so anyway, we've looked at what is inherent risk. Now we're looking at control risk and detection risk. What do I mean by control and detection risk?
Control risks means protect the safeguards, protect the danger.
Okay, let me explain this. See, now generally this happens in my house. If I buy, this happened just yesterday. If I buy a brownie, no, I'll not say control risk. No, Manat, no. Listen very carefully. If I buy a brownie, I did buy a brownie. If I buy a brownie, I need to protect it. Why do I need to protect it? Because I have a brother. I need to safeguard my brownie. Right? And I will put controls in place to safeguard my brownie from my brother. For example, I will put my brownie in a locked jar. Right? I've put my brownie in a locked jar so that my brother does not take it. So here what I have done is I have some controls in place to safeguard theft, safeguard fraud, safeguard error. Now there could be a chance of error also, right? Maybe I keep the brownie in the jar, and then my mother, if there's any guest, she opens the jar and gives it. Now that is an error. So I have some controls in place to safeguard my brownie from theft and error, from fraud and error. Fraud is in case of my brother, and error is in the case that my mother will take it and give it to somebody, some guest, which I will not be very happy if that happens. Right? So I have some controls in place. I have some controls in place to protect from fraud and error. And in this, such a basic, silly example, if there are controls necessary to safeguard my brownie from my brother, if I had controls, do you think companies need controls to safeguard from fraud and error? Do you think companies need controls in place? I needed a control. I needed what? I needed a locked jar. Do you think companies need controls also to safeguard from fraud and error? Do you think company needs a CCTV to see who is stealing? Do you think companies need controls? For my brownie, 200 rupee brownie itself, I need controls. So do companies need controls? Yes. But remember, guys, as much as we say that we need controls, I'm putting it in green because controls are needed. As much as we say that we need controls, what if this locked jar, my control, there's a control I have, my control is a locked jar. What if that locked jar is damaged? What if the control fails? Even though I have locked it, even though there is a control, the jar itself is damaged such that anybody can take the cookie out. So there is always a risk that your controls fail. There's always a danger that your controls fail. Your controls don't work like they were supposed to. There's always a danger or risk that your controls fail or don't work as they were supposed to. Because the controls have failed, we are now a victim of fraud and error. This type of risk, this danger that the controls fail, this danger is known as control risk. So, what is a control risk? A control risk is the risk that your controls fail. You agreed that you need controls, but there's a danger that your controls are not strong enough. Your controls are weak. We agreed that we need controls, but there's a danger that the controls are not strong enough. They're not able to catch or prevent fraud and error. This danger, this risk is known as a control risk. Okay, so a control risk is the risk that your controls fail. Control risk is the risk that the misstatement could occur and could be material, will not be prevented, detected by the company's controls. Again, you can make a note of this because this will help you understand what it is from a conceptual point of view. A control risk is the danger that the controls that you have implemented fail or they are not strong enough to catch, prevent, detect fraud and error. That danger is the control risk. So there's an inherent risk. There is a natural risk. Inherent risk is the natural risk. In this case, inherent risk is that my brother, there's a natural danger that my brother tries to steal my brownie. This is like a natural risk, natural danger. That risk is inherent risk. What is a control risk? Control risk is I have controls in place. I have locked it. But the danger that my control will fail, that danger or that risk is control risk. Then comes detection risk. Again, I have given an example from the company's point of view also, right? And that is CCTV. You have kept a CCTV as a control to check. But what if the CCTV doesn't work? This happens. I saw that just even recently, I saw this news that somewhere some theft happened. They tried to open and check the CCTV, but the CCTV itself is not working. Why did they keep the CCTV? To control, correct?
Yes.
As a control measure, they kept the CCTV. But if the control itself fails, that danger is a control risk. Then comes detection risk. if a fraud error has happened, the auditor is expected to detect it and catch it, correct? That's why we hired the auditor. Auditor is an investigator, he's an inspector. He has to detect, he's a detective. He has to detect and catch errors. Correct? But go back to my cookie example, go back to my brownie example. See, if there were 24 brownies in the box, and my brother stole one, I should be able to detect it, correct? I should be regularly counting my brownies, and I should be in a position to catch somebody has done fraud and error. I should be, see, control risk is yes, I had some controls in place. I had a locked cookie jar, but that failed. That is control risk. But after the fraud and error has happened, the auditor is expected to catch it.
Sir, repeat again. Detection risk.
Again, I have not completed it. Pika, please wait. I'm completing. What is detection risk? This is, I am supposed to, as an auditor, as an inspector, as a detective, I'm supposed to catch fraud and error. I'm supposed to detect it. I'm supposed to spot it. But there is a danger as an auditor, I'm supposed to catch, detect the fraud or error, correct? But there is a danger that I don't. I didn't detect the fraud or error. That risk where the auditor fails to detect fraud and error is a detection risk. You understand? For example, give me a minute. See, there is so many advice. Correct? If I ask most people, they will say there's no mistake. If I say, can you detect the mistake? They will check advice everywhere. It's advice. There's no spelling mistake anywhere. But there is. See here. Again, it's not an incorrect spelling, it's just a different spelling. I am supposed to detect the mistake. I'm supposed to catch the error. I'm supposed to detect the fraud. But there is always, see, I'm not a superhuman, no? I'm not Superman. Even as the auditor, you are also not Superman. So there is still a danger that you as the auditor fail to detect fraud and error, and that risk where you, the auditor, fails to catch, detect the fraud or error is detection risk. That risk or danger where the auditor fails to catch or detect fraud or error is detection risk. Detection risk is the error where the auditor fails. Human isn't human, we're talking about the auditor. That risk is detection risk. So, what is detection risk? The risk that the procedures followed by the auditor will not detect, will not catch a material misstatement. There's a danger that the auditor is unable to detect fraud or error, and that risk is detection risk. Going back to my example, I am supposed to catch, see, if my controls failed and my cookie jar is left open, even then, I am supposed to detect it. One cookie is missing, right? I'm supposed to catch it, but if I fail to catch it, I just see the cookie jar and I think all the cookies are there. If that happens, I failed to detect the theft.
आवाज आ रही है ना?
I failed to detect the fact that the one cookie is stolen. That risk, that danger is known as detection risk. Right? So inherent risk is the natural danger that something will go wrong. There could be fraud or error. It's natural. In anything, there can be some error. We know this. Inherently, naturally, there is risk. And inherent risk is higher when you do something that is more complicated. Obviously, naturally, if you're doing something more complicated, the chance of the risk of misstatement is high. Naturally, that risk is inherent risk. Control risk is what? In order to prevent, what is control risk? I'm typing it again. In order to prevent or detect fraud and error, the business has some controls in place. That danger or that risk that the controls fail, that danger is known as control risk. Right? In my example, I had a control in place. I had kept my brownies in a locked jar. That was a control. That was my way to control fraud and error. Same way, companies will also try to control fraud and error. But there is a danger that their controls fail. That risk is known as control risk. Finally comes detection risk. Detection risk is basically that risk that the auditor fails to detect fraud or error. Just like how you failed to see a mistake here. You failed to detect a mistake. So that risk, that danger that you as the auditor fail to catch or prevent, rather in this case, catch fraud or error, that risk is known as detection risk. Yes, Ritika?
Sir, inherent risks and detection risks are same.
Inherent risk is what?
Is it a natural mistake from the
Can you
auditor?
tell me what is inherent risk?
Sir, natural mistake.
Natural mistake. What is inherent risk?
Sir,
And
I
what
have
is
doubt
detection
in
risk?
inherent and detection risks.
Yeah, what's the doubt? What is
Sir, I
inherent?
do not
You understand.
understand what they are saying, inherent and detection risks.
Okay. My question is, according to what, how much you understood, what is inherent risk?
सर मतलब मिस्टेक को वो लोग मतलब पा नहीं रहे, मतलब खोज के नहीं निकल पा रहे हैं, उसके लिए लोग कंट्रोल लगा रहे हैं वो मिस्टेक को
Inherent risk is You said now, just some time back, 2 minutes back, what is inherent risk? There is a natural danger that something goes wrong. Anything can go wrong. That risk is inherent risk. Natural danger, something can go wrong. In this case, there's a natural danger that my brother can steal the cookie. There's a natural danger that you record the invoice wrongly. There is a normal natural risk. That risk is inherent risk. Detection risk, you are supposed to catch it as the auditor. That's your job. If you don't detect it, that is detection risk. So inherent risk is the natural danger, natural risk that something goes wrong. Either there's fraud or error. Naturally, anytime there is always dangers. When you go out, there is a natural risk that somebody steals your money. That's normal, natural. Somebody steals your wallet. This is a natural danger. But the detection risk is you fail to detect that somebody has stolen your wallet. Failing to detect fraud or error. So tell me one thing, Ritika, when you go out, naturally there is a danger that somebody will steal your wallet. Yes or no?
Yes, sir.
That is inherent, no? That is a natural risk.
Yes,
How is
natural.
it the same? Detection risk is when you don't realize, you are not able to detect and see that somebody has stolen it. You're nicely going home and you nicely go and sleep. You fail to detect that somebody has done fraud or error. That is detection risk.
So
How,
give one more example on detection
what
risks.
did can you explain this example which I mentioned?
Which example, sir?
This example in front of the screen.
Failing to detect fraud and error.
This example that I just gave now. When you go out, what is
Yes,
the natural risk?
money got stolen.
There is a natural risk, yes or no?
Yes, sir.
That risk is inherent risk. Naturally, there can always be
Yes,
fraud.
sir. सर डिटेक्शन रिस्क मतलब
No,
हम
no,
लोग
no, don't go
रिकॉर्ड
to
करने
detection.
भूल
Wait,
गए.
wait, wait. Don't go to detection. Inherent, first one by one.
Okay,
Inherent
okay.
is the natural danger that some fraud can happen, some error can happen. From a company's point of view, maybe there is a danger that you record the transaction wrongly. There is a natural danger. Maybe fraud, maybe error. But there is always a danger that somebody naturally tries to do some fraud. Not everybody is honest. That risk is inherent risk. Is that clear? Ritika, I can't hear you. Guys, are we all clear with inherent risk?
Yes, sir. Now clear, sir.
Detection risk is, as an auditor, you are supposed to catch fraud or error, but there is a danger, the risk that you are unable to catch it is detection risk. For example, when you go out, somebody has stolen your purse. Now you are supposed to detect it, correct? You should see, oh, my purse is not there. The risk that you are unable to detect the problem, there's a danger that you are unable to see the problem. That risk is detection risk. Another example is, again, there was a mistake. See, there was a mistake in the financial statements. A transaction was wrongly recorded. That is okay. That is an inherent risk. But as an auditor, you are supposed to catch it. You're supposed to detect it. But the danger that you are unable to detect the mistake is detection risk. I'll give you one final example. Inherent risk is there is a natural risk that you might catch COVID, for example. Natural risk during COVID, there is a natural chance, natural danger that you catch it. That is inherent risk. Now, what is detection risk? As a doctor is supposed to properly diagnose it on time and detect it. But is it necessary the doctor will properly be able to diagnose and detect? Many times doctors don't diagnose properly. They are unable to detect correctly. The danger that the doctor is unable to detect the correct problem, that danger that you're not able to detect the problem, you're not able to spot there is a problem, but the risk that you are unable to catch it is detection risk. The danger that the doctor is unable to detect and properly diagnose the risk is detection risk. The disease he is unable to catch, he is unable to detect the disease. That risk, of course, if he is unable to detect on time, the COVID will get worse. That risk that the doctor is unable to detect the disease, there is a danger of that. That risk is known as detection risk. Everybody clear? Quickly, guys. Inherent, control, detection.
सर डॉक्टर लोग अनेबल टू डिटेक्ट द डिजीज, तो सर वो लोग तो प्रोसेस करने के बाद तो लोग को डिटेक्ट हो ही जाएगा.
No, how is that possible? Not all the time you will catch a disease. Sometimes doctors to detect.
Take time, sir.
No, not takes time. Sometimes they don't detect properly. Sometimes they don't diagnose properly. It's not always the case that doctor detects the disease correctly. Sometimes they are not able to. Sometimes they mistake the disease for something else. Sometimes they will mistake the COVID for common cold. Does that never happen? Doctor is not able to detect properly. That risk is detection risk, where you are unable to detect the issue. You are unable to detect, you are unable to catch the problem is detection risk.
Okay, sir. Thank you, sir.
So inherent risk, control risk, detection risk. These are the three types of risks that we looked at. Just have a look at what we have looked at so far. Everybody, 4 topics. Quickly go through. So guys, we have looked at risk of material misstatement. We have looked at what is a misstatement. We have looked at types of misstatements. The other one. Types of misstatements, factual, judgmental, projected. We have looked at inherent risk. We have looked at control risk. We have looked at detection risk. And in the last class, I did mention what is professional skepticism, right? So again, the ones who've missed it or want a quick recap of this was done on the 2nd of April in the last 10 minutes. So you can catch that up there. But this is a topic that was already covered in 2nd of April, right? So professional skepticism was done in the last class. Now what we're going to look at is materiality. What is, in simple words, what is materiality? Well, how do I put this? Material, in simple English, means big, sizable, right? Material is what? Sizable, big, significant. See, from my cookie jar, I have 200 cookies. If somebody steals one, It's not significant. It's not material. Material in English means significant. So big enough to affect the decisions made by the users. What do I mean by that? Is just a couple of days back, we were doing our accounting. Chartered Academy was doing our accounting, right? And when we were doing our accounting, I was explaining to the accountant all the expenses. Okay, 30,000, 35,400 we paid for the software. Okay, 60,000 rupees we paid for rent. I was explaining everything, but whenever small amount came, like 100 rupees, I said, just ignore it. I said, ignore it. Why? Because this is an amount that isn't material. It's not significant. I mean, I don't care where did I spend this 100 rupees. It's not going to affect a decision made by my partner. It's not going to affect anybody's decision. It's a very small amount. So material is basically an amount that is significant, big enough to affect the decisions made by the users. What is material? Material is right. So again, what is material? Material is basically a significant thing that is big enough to affect the users, affect the decisions made by the users. Right? That's why generally in big institutes, one student may not be material. It may not be like significant enough because they have thousands of students. So one student, if gets dissatisfied and leave, they don't care much. But places like Chartered Academy, where we keep our batch size small. Purposely. Even one student matters. So materiality means something that is significant enough. Do you understand? Material enough, big enough to affect the decisions made. Right? So for example, from your cookie jar, if just a few sprinkles fall off, nobody will notice. Right? For example, you are making dessert. Just if a few sprinkles of sugar get missed, no problem, nobody will notice. No one will notice, everyone will eat happily. But in the dessert, in the sweet, if you completely forget to put sugar at all, this is big, this is significant, there is no sugar in dessert, everybody will say, what is this? That danger is a big danger. So material is basically when something is significant enough to affect decisions made by the users. That's it. Yes, Ashmit, very good. I'm coming to that part. Can materiality differ from company to company or is it standard? Very good question. Again, if you ask me, is 2 lakh rupees important to you? Is it big to you? Is it significant for you? I will say yes, it is a big amount. For me, it's a very big amount. It's a very big amount, huge amount. Then you go and ask a sheikh, a rich Arab country sheikh, or you ask a billionaire, is 2 lakh rupees big enough for you? He will say, what 2 lakhs? He will say, my socks are 2 lakh rupees. So, what is material, Ashmeet? Good question. What is material is not going to be standard. It's going to be something. For me, what is material? Say for me, I'll say, as I told you in my example, 100 rupees, I said ignore it. I said ignore. But say for a gentleman sitting on the road and asking for money, he will say 100 rupees is a big amount. For him, it is significant. For me, it is not. For me, 2 lakh rupees is significant. But for a billionaire, for a ruler, 2 lakh rupees, he will say, what 2 lakh rupees? So, no, it is not standard. It is going to be how much amount is material will definitely vary. You understand? And that's exactly what we are going to look at right now. How much is material? Right? See, we're going to look at material by size. Again, Ashmeet, one amount you cannot say this much, anything above this amount is material, anything below this amount is immaterial. You cannot say that. It depends from company to company. Right? For example, for a $1 billion company, for a $1 billion company, 2 lakhs would not matter. It'll not be material. Why? Because they have revenue of 7,000 crores. You understand? So here, ISA, International Standards on Auditing, ISA 320 tells you that you can use these benchmarks to assess whether something is material or not. So if we are talking about an amount which is half or 1% of your revenue, we will say it is material. Anything below that, immaterial. That could be taken as a benchmark. So for a big company with $100 billion of assets and revenue of say $10 billion, 1% of that will be how much? 100 million. Anything less than 100 million is not material for them. So the thresholds given to you are either half to 1% of revenue or 5 to 10% of profits before tax or 1 to 2% of assets. This is considered material. Anything below this, you will say immaterial. The material by size is when, again, it's an amount. Again, an amount, say a 5 rupee expense may not be material for me, Fin Chartered, because it's a small size. It's a very small amount. That is what I mean by material by size. Okay, so I hope material by size is clear. The next example is material by nature. Now, I generally give analogies and examples to understand things. And say you tell your friend, get lost. Or you say, chal nikal. This is okay because you're telling this to your friend. It's not a very big deal. It's not a significant thing. It's normal. Correct? But suppose you say the same thing to your father. Now, this is a very big problem. Certain things are big things by the nature of it. We're not looking at the amount. We're not looking at things from a financial, from a numbers point of view. We're looking at things from its nature. So to tell your father something like this, it is a big issue. It's a significant concern. It's a significant problem. So material by size is where we're looking at numbers. Material by nature is looking beyond numbers. Some things we are looking at things that are significant, big enough from a nature point of view. Right? So here there are no numbers involved. But this is something which is definitely material from a nature point of view. I mean, it's the nature of it is very serious. This is a very serious statement that you are saying. So material by nature would be, there is a misstatement about certain laws, certain compliance. There's a misstatement that affects compliance with regulatory bodies. Compliance with regulatory bodies. Now, obviously, this is material by nature because of course, just like how you cannot non-conform with your father, you cannot non-comply with regulatory bodies because then you will be in trouble. They will put fines, they will put penalties, they will suspend you. You understand? So a misstatement that affects compliance. Compliance means, in simple layman terms, obedience, following. This is a misstatement that is big because of the nature. It is violating regulatory bodies, and we don't want to violate regulatory bodies because if we violate regulatory bodies, we will be in trouble. This is a big problem. Those kind of, that materiality you can say is material by nature. Again, I'm highlighting that in blue. One example is there is a misstatement that affects compliance with regulatory bodies. Again, by nature, from a nature point of view, this is a very big problem. Right? Again, misstatements that affect compliance with loans, that affect following rules about debt. Now, again, if you don't follow that, you'll be in trouble. These kind of misstatements are material, they are significant because the nature of it is big. That material, that kind of material is known as material by nature. So you have things that are material by size, you have things that are material by nature. So Ashmeet, have I answered your question? Right? Now, what is left? We're looking at performance materiality, we're looking at analytical procedures, post which this chapter will be done with doing audit risks. Now, audit risks are very important risks that you need to be aware because you do have section B questions from this. So, Ritika, you keep asking from the exam point of view. So, audit risk, again, from the exam point of view, is awfully important. And once audit risk is over, this chapter is over. But again, so far, what have I seen? I have seen what is a misstatement. I have seen what is risk of material misstatement. I have seen categories of misstatement. I have seen inherent risk, control risk and detection risk, inherent risk, control risk and detection risk. I have seen professional skepticism, and I have completed materiality along with material by size and nature. Now, post break, we will come back, do performance materiality. In fact, analytical procedures we will look at in more detail in a later chapter. Right? Performance materiality is there. Analytical procedures, as I said, we will look at in more detail. Post which we have audit risks, which would be the last topic of this chapter, which is very, very important. Post which we can easily move to, we can say the 5th chapter is over. Yani 1/3 of the syllabus is done. Again, it's 6:55, but because about a minute of the time is over, you can come back by 7:06. You have a 10-minute break. Yes, guys, welcome back. So it's 7 p.m. Are you all back? Just confirm. Just let me know in the chat box. Yes, perfect. So guys, now what we're looking at is we're looking at, I think I will start with audit risk. I'll just come back to performance materiality. Now, this takes me back to the first page of this chapter. I purposely ignored the first page of this chapter. But what is there on the first page of this chapter? It says, what is audit risk? Now, what is audit risk? Again, if I have to further simplify it, see, there is a client. That client prepares financial statements. These financial statements need to be audited, need to be checked, audited and examined. And I need to give an opinion whether these financial statements are true and fair. But there is a danger that after doing the audit, after doing the examination, there is a danger that I give a wrong opinion. After checking, I say that the financial statements are free from material statements. But actually, there are big misstatements in the financial statements. So altogether, the danger that the auditor gives a wrong opinion about the financial statements, that risk is known as audit risk. Audit risk is the risk that the auditor, the danger that the auditor expresses an inappropriate opinion, an incorrect opinion on the financial statements. Would you want this, guys? Would you want that you hire an auditor and after doing an audit, he gives a wrong opinion? Would you want that? Would you want such a thing to happen? No, definitely not. That danger, that risk that the auditor expresses an inappropriate opinion is audit risk. And again, I will give you one small analogy to help you understand this. I did give this example, but in my room the other day there was a cockroach. I asked my friend to go and check, go and audit, go and examine and see if there is a cockroach or not. So my friend is the auditor. He is going and investigating. He is going and checking. Now, after checking, my friend tells me there is no cockroach. But actually, in reality, you see, I don't know why the cockroach in my drawing looks like that. But actually, in reality, there is a cockroach. So my friend gave a wrong opinion. This danger that the auditor will express a wrong opinion on the financial statements is audit risk. Now, the ending of this chapter is talking a lot more in detail on audit risks. You understand? And people do not understand the difference between audit risk and business risk. For example, there is a business. This is the business. There's a company. And customers are supposed to pay the company. But if the customers don't pay, there's a risk. There's a risk. There's a danger. What is the danger, guys, if the customers don't pay to the company? What will happen? What is the risk? If the customers buy the products, but they don't pay, what is the risk? People are saying that there will be bad debt. Everybody is saying if customers don't pay, we will not be able to recover our receivables. So our bad debts will go up. Bad debt means money that you were supposed to get from your customers, but you haven't. Somebody was supposed to pay you debt, but they didn't. They ran away, they blocked you, they passed away. Now, you all are saying that the danger, if the customers don't pay, there's a risk. And you're saying that the danger is bad debts will go up. This is a problem for the company. This is not a problem of the auditor. Remember, I mean, I'm an auditor. Why do I care about your customers not paying you? This above problem is not the auditor's problem. If the customers are not paying, chase them, get the money. It's not my problem. Don't tell me. If the customers don't pay, it is the company who will suffer. Auditor doesn't care about it. Company is unhappy because they will not get their money. Remember, auditor is just an inspector. If customers don't pay the client will not get profits. Is the auditor hired for the client to make profits? No. Auditor is only hired to check if the financial statements are true and fair. Auditor does not care if your profits are going up, if your profits are going down, if you're able to collect your money on time. Auditor does not care about this. Oh, your bad debts will increase. So what? It's not my problem. Bankruptcy also, it's not my problem. Company will close. So what? My job is only to check if the financial statements are correct and to give an opinion about the financial statements. That's all. The company will shut down. That's not my problem. My only problem is that the financial statements could be wrong. I don't have a problem if the company closes. I don't have a problem if the company does not make profits. I don't have a problem. I just don't have a problem with any of that. So the business and whether we are able to collect money or not is not the auditor's problem. Auditor doesn't care whether you are able to collect profits, collect cash, make money. Auditor does not care about this. Auditor is only and only worried about what the financial statements. Auditor is only worried. The only worry for the auditor is that the financial statements are materially misstated and we will give a wrong opinion. That's all. So you people need to start thinking like an auditor. The auditor's only concern is the financial statements could be wrong, and the auditor's only fear is that he will give a wrong opinion. Auditor does not care about the company. Did the company make profits? Did we make loss? Did we earn money? Did we collect our receivable? That's not my problem. That is the company's problem. So coming back to this example, when there is a company and the company is not able to collect its receivables, company will not make money, but that is not the auditor's problem. The company sells on credit and is unable to collect its receivables. That is not the auditor's problem. So sorry, the company will not make money, will lose money. This is not the auditor's problem. Not at all the auditor's problem. This is a risk to the company. This is a risk to the business. And therefore, these type of risks that will negatively affect the business is a business risk. It has no risk to the auditor. Audit risk is the risk that the financial statements will be wrong, that the financial statements will be materially misstated. That is the only danger. That is the only worry for the auditor. So audit risk is the danger that the financial statements are misstated. So for example, if the customers are unable to pay, there is a danger that in the receivables, I say that, okay, customers are about to pay me 10 crores. For example, Fin Chartered Academy, We have receivables of 8 lakhs. But what is happening? Look at this. Customers are not able to pay. So for the auditor, the only danger is this 8 lakhs is incorrect because a lot of them will not pay. This is the risk for the audit. Whether the company will make money or not, I don't care. The auditor's only risk is that in the financial statements, we have overstated the receivable. Can we get 8 lakhs? No. Many of them are unable to pay. We will only get 2 lakhs. So this 8 lakhs is wrong. And as the auditor, can you allow misstatements in the financial statements? Yes or no? Again, I'm seeing people leaving slowly. There were 8 people, now there are 5 people. Can we allow misstatements in the financial statement, guys? No. This is the only problem for the auditor. So the thing that the customers are struggling to pay, the problem that the customers are struggling to pay, the business risk is what? Business risk is the company will lose money. That is a risk to the business. The auditor's risk is because customers are unable to pay, receivables will be overstated and financial statements will be wrong. This is the only worry of the auditor. Financial statements will be wrong. Why? Because in the financial statements, I have put receivables of 8 lakh rupees. But will I get those 8 lakh rupees? No. Why? Because customers are unable to pay. Right? So in simple layman terms, audit risk, auditor's worry is simply that financial statements will be wrong. That's all. The auditor is a very peaceful guy, guys. When you become auditor, your life is very simple. You don't have many worries. Your life is very easy. You can comfortably sleep at night. The auditor's only risk is that financial statements will be materially wrong. That is his only worry. The business struggles, the business is able to collect money, the business is not able to collect money, the business will not get money, the directors will not be paid salary. That's not my problem. My only problem is this piece of paper that I am investigating. This piece of paper should not be wrong. That's all. This financial statement should not be wrong. End of story. That's my only worry. Other than that, I don't have any worry. So that's why when customers are struggling to pay money, the auditor's danger, the auditor's worry is that in the financial statements, receivables will be overquoted, overstated. I'm still expecting 8 lakh rupees, which is wrong. That is the only worry of the auditor. Company profit going down, that's not my worry. I don't care. My only worry is this piece of paper. This piece of paper should be correct. Whether the company lives or dies, I don't care. And with that, let's look at the third example. Revenue is going down. People are not buying from us. And what are we saying? We're saying that cash flows are negative. We don't have any money. We don't have any cash. What will a layman say? What is the auditor's risk? Let me ask you guys. business is falling. The company will shut down because business is falling. Is this an audit risk or no? Is this a worry for the auditor or no? The company will shut down. All of you think in time. Quickly. No. I mean, I don't care. Is the company closing down? I don't care. I really don't care. My only problem is if the sales are going down, and the company shuts down, it needs to be reflected correctly in the financial statements. If the company is shutting down, I don't care. But it needs to be properly reflected in the financial statements. For example, financial statements need to be prepared in a way as if the company is going to shut down. Again, there are people who will use technical terms and say financial statements need to be prepared other than going concern basis. Don't complicate life. We will look at all that. But the auditor will not be worried about the business falling. The auditor will not be worried about the company shutting down. I don't care. The auditor's only worry is if the company is going down, if the business shuts down, it needs to be properly reflected in the financial statements. Meaning, financial statements must be prepared according to the fact that the company is shutting down. End of story. So again, have a look at this. The business risk is that there will be a problem that the revenue will fall and the profit will go down and the company will close. That is a business risk. For the auditor, the danger is that if the company is closing down, we need to prepare the financial statements in a way that properly discloses the fact that the company is closing. That's all. I don't care whether the company is closing down or not. I just need to properly mention it in the financial statements. That's all. Next risk is the client operates in a fast-paced industry. For example, the client is in FMCG, fast-moving commodities and goods. Works in food items. And the problem with food items is they get spoiled fast. Food will get wasted and therefore money will be lost and profits will go down. Is this a worry of the auditor? Money in food will get wasted. We will lose. Money will be lost. I bought tomatoes and came, but the tomatoes get spoiled in 2 hours. Our money is lost. Is the auditor worried about that? No, very good, Ashmi. Auditor doesn't care. This is only a problem for the business owner, not for the auditor. This is a risk to the business owner, not to us. What is the danger for the auditor? Again, remember, he is only bothered about this piece of paper. If food is getting wasted, food is inventory, correct? We are selling food. So the problem is inventory. We say we have inventory worth 4 lakhs. But say 3 lakhs worth of inventory is wasted. But if I still show 4 lakhs in the financial statements, this is A misstatement, why? Because 3 lakhs worth of inventory is wasted. Showing 4 lakhs in the financial statements is a big problem. So food is getting wasted, money is being lost, profit is going down, I don't care. My only thing is, if the food is getting wasted, if inventory is getting wasted, there's a danger that if we don't adjust it in the financial statements, the inventory will be overstated. What do I mean by overstated? See, I have in my financial statements inventory worth 8 lakhs. But if the food is getting wasted, we need to properly adjust it in the financial statements and show the correct value of the inventory that we have. 4 lakhs out of 8 lakhs, 3 lakhs worth of inventory is gone, wasted. So it needs to properly be shown in the financial statements that inventory is only worth 5 lakhs. So the auditor, in simple words, guys, this is a topic that is asked a lot. And unfortunately, people are not able to differentiate between audit risk and business risk. Again, in simple layman terms, what does an audit risk look like? When there's a problem, you need to think what could go wrong in the financial statements because of the problem. That's how you will identify audit risk. And easily identify audit risk. For example, if customers are struggling to pay, business will lose revenue, business will lose profits. I don't care. I only have to see how will it affect, what could go wrong in the financial statements. If customers are unable to pay, receivables will be overstated. I'm expecting money, I'm expecting to receive 20 lakhs, but because customers are not able to pay, this is overstated. I'll only get 8 lakhs. So anytime you see a problem, just think, how will it affect the financial statements? What problem will it lead to in the financial statements? Same way, the client operates in a fast-paced industry. Again, inventory being wasted, money being lost, profit being lost is not my problem. Just think, how will it cause a problem in the financial statements? Because as the auditor, I mentioned this here, the auditor's only worry is the financial statements. Financial statements should not be wrong. That's all. So when you see a problem, ask yourself a question. Don't ask, oh, how will it affect the business? No. Business will lose money, business will lose inventory. We have to throw the tomatoes, we have to throw the potatoes, not my problem. How will it affect the financial statements? Oh, inventory will be overstated. That's the problem. Revenue is falling, business is struggling. Again, business will close down, director will try to commit suicide, director will blame other people, not my problem. My only problem is if business is falling, it needs to correctly be shown in the financial statement. The risk is that we will not properly disclose in the financial statements the problems. So it's not there in the textbook anywhere. This is just a tip I am giving you. Whenever you see a problem, like here in this case, you have seen 3 problems. Whenever you see a problem, ask yourself, how will this problem affect the financial statements? And that is your audit risk. So this is like a pro tip. Whenever you see a problem, ask, what negative effect will this have on the financial statements? I'll give you one more example. Large loan taken by the company. Large loan taken by the. Tell me, how will it affect the financial statements? What effect will it have on the, what is the danger for the financial statements? You just need to ask, what could go wrong in the financial statements? What could the danger be to the financial statements? What do you think the danger will be? A loan is a liability, remember. So what could the danger be? Just ask yourself one question. How does this affect the financial statements? You've taken a loan. What is the danger? Let me put one danger, one risk. The company will have too much pressure to repay. Is this an audit risk? The company will have too much pressure. The director will not be able to sleep at night. He will be worried about the loan. Is this an audit risk? No, very good. So what is the audit risk? For an auditor, what's the danger? Okay, loan is a liability. Again, you just need to ask, what could go wrong with the financial statements? So you will just say, my only concern is this loan needs to correctly be mentioned and updated in the financial statements. The liability should not be understated in the financial statements. For example, very good. Loan is a liability. As of now, I have a liability of 2 lakh. But because we have taken a large loan of 1 crore, my only worry is liability is understated, which is a very big problem. I want, my only worry is that the liability will not be properly shown, properly disclosed, properly stated. See here, after taking a loan of 1 crore, in the financial statements, if it shows a total liability of 2 lakhs, will the auditor be happy? No, because the financial statements are wrong. The only worry for the auditor is that in the financial statements, the liability will be understated. See, I have taken a loan of 1 crore, but in the financial statements, it's showing only 2 lakhs. And properly, very good point. We need to properly record all the interest expenses, because if interest expense is not recorded, then again there's a problem. So the large loan taken by the company, just ask yourself one question. How will it affect the financial statements? What could the problem be in the only this one word you should focus on, FS, financial statements. What is the danger? The company not able to pay, the director not able to sleep, the manager blaming the subordinate, there will be fights in the company, the chairman tries to commit suicide, not my problem. The only problem is in the financial statements, there is a danger that the liability is understated. So just ask yourself one question, one single question. How will it affect the financial statements? What is it in the financial statements that needs to be adjusted? And if it's not adjusted, there will be a mistake in the financial statements. Okay. I'll give you one more example. I'm just thinking of an example. The company is giving discounts, too many discounts to customers. Meaning their selling price is going down. Instead of selling something for 50 rupees, I am selling it for only 35 rupees. We're giving discounts. Let me ask you one question. The company's revenue falls, and so earnings go down. Is this an audit risk? Yes or no? The company's revenue will fall. So our earnings, our income will fall. No, I don't care whether your income falls or not. The only problem I have is revenue should not be overstated in the financial statements. We need to properly record the correct revenue, the correct discounted revenue. Otherwise, financial statements will be wrong. So your only word here to look at is FS, financial statements. And if that is clear, guys, audit risk is done, because after that, the only thing that we're looking at is auditor's response, which is very easy if audit risk is clear. So guys, for the next, oops, sorry, this is audit risk. So for the next few days, guys, maybe the next, say 1 week or so, we will be ending a little early, maybe 10-15 minutes early. But just review these topics, these 7 topics, and let me know your rating out of 5 quickly. Because generally people struggle with audit risk, substantive procedures. That's why I've tried to give you as many examples as possible. And again, I've given you a cheat code. Just ask yourself, how is this problem affecting the financial statements? I don't care how the problem is affecting the company, how it's negatively affecting the director, what problem the manager is having. I don't care. How is it making a negative effect on the financial statements? How is it stopping the financial statements from being true and fair? So the cheat code is just ask one question. How is the problem possibly stopping the financial statements from being true and fair? That's all you have to ask. So again, please go through. If there are any questions, type them. This is the cheat code. Quickly, guys. All right, that's all, guys. Thank you so much. I will see you in the next.